Hi there, my name is Jamal Khan. I'm a Senior Tax Partner at Churchill Tax Group. Thank you for joining our latest webinar. In this webinar, I'm going to be talking about one of my favorite topics, which is tax planning on properties, high value properties, and how to mitigate your tax liabilities by transferring properties into limited company in a very tax efficient manner. This webinar arises from one of my recent cases. A client contacted us and needed tax advice. They had a couple of properties and they didn't know what to do, but they were both high rate taxpayers. So this is actually a real life case study that I thought I'd share with my audience and my followers. And just to give you an idea of how beneficial tax planning can be and how much money can be saved by speaking to a tax specialist. Right, so please pay attention, and if you've got any questions, always get in contact with me. Right, so let's get started. This is a little bit about us, who we are. We're a leading tax specialist firm, chartered tax advisors, tax barristers, HMRC, tax inspectors. So we've got quite a nice team of tax specialists. And we are quite well known in the UK, especially amongst the accountants, lawyers, who we get a lot of work from in terms of tax advice. So the agenda today is a real life case study: transfer of property into a limited company, capital gains tax relief, stamp duty benefit, income tax benefit, and how inheritance tax benefit was achieved from this tax planning that I did for a client. Case study. So, not using the real names, but anyway, John and Sarah came and saw me. They had 3 children, lived in a house worth about £850,000. Originally purchased that for about £300,000. John and Sarah are high earners, and they decided they needed to live in a better house. So they bought a house worth £2 million and moved in. They paid stamp duty on this house of about £153,000. The former matrimonial residence was put on rent with a mortgage. And John and Sarah are both higher earners, higher rate earners, paying tax on rent at about 67%, because you don't get tax relief on interest anymore, and they're both receiving high salaries, so they would effectively pay tax at 67% on the rental income. And they came to me for tax advice. Now, the first thing that we would do in such a situation is to see what would be the most beneficial way of restructuring their tax affairs. So my suggestion to them was to transfer the formal matrimonial home in which they used to live in into a limited company. Normally there would be a capital gain on that property of about, they bought it for £300,000, the market value of the property was £850,000, so there's a gain of about £550,000. But as we transfer this property into limited company, the gain would be exempt because they lived in that property before, so there would be no capital gains tax to pay. And this essentially effectively means that you save a lot of money here. That's quite a substantial saving there. The second step was stamp duty land tax. So when you transfer a property into a limited company, there would be stamp duty payable. So on this occasion, they would pay about £58,000 on transfer of the property worth £850,000 into a limited company. But what would happen at the same time is, now they would be able to claim back the stamp duty refund on the purchase of a new house of about £60,000. So they've paid £58,000. They get back £60,000 from HMRC because they bought their new house recently within the last 3 years. So in fact, there's a benefit to them immediately on stamp duty as well. Income tax, yeah. So this is where the main benefits sit. So they transferred their main home to the previous home to the limited company, and because there was no capital gains tax, they do it through director's loan account, and they've created a director's loan account worth £850,000. The company receives the rental income, it gets full tax relief on the mortgage interest, and therefore pays corporation tax at 19% on the profits. But what's interesting here is that John and Sarah can withdraw profits from the limited company through their director's loan account worth £850,000 tax-free for many, many years to come, many generations to come, because the property is generating, say, rent of £1,700 a month, £1,700 a month, 17, I think it's about 1,700. Annually is about 20,000. 20,000 minus expenses is 25,000, 22, 16,000, 14,000, and that's how many 14,000s it will take to get to 850,000 in many years. So they're not going to be paying income tax on this. In fact, what they could also do is they can remortgage the property within the company and get that money out of the company tax-free. The mortgage rate raised tax-free. So there's a lot of benefit here. And when I explain this to my client, who are both paying tax at 67% and 40%, and then plus the additional Section 24 charges, when I explained it to them, they said, "Wow, how can that be?" So this could be a real game changer for people who want to do some transfer some properties into limited company. Right, inheritance tax. This is also an interesting one because as they have now created a director's loan account and they have shares in the company, because they did not use incorporation relief, they can gift the shares in the company to the children, and they can also gift their director's loan account to the children without incurring any capital gains tax or other taxes. Yes, the condition would be that they would still need to stay alive for at least 7 years without it, so that inheritance tax doesn't kick in. But other than that, they can gift the shares to the children. So this is a kind of very simple way of putting together a very complex tax planning. But if you think about it, the savings they have achieved, so you've saved tax, income tax, you've saved capital gains tax, stamp duty. In fact, you paid 58,000, but you got back 60,000. So stamp duty was almost a break even, but still a small advantage. Income tax, you're not going to be paying income tax for the next how many years until the director's loan account is run out. And your children are not going to be paying income tax on withdrawing from this company. And inheritance tax, which is at 40%. And if we take out £850,000 at an inheritance tax rate of 40%, that's £340,000 of inheritance tax saved as well. And that simple exercise could lead to so many tax savings. Something worthwhile considering, and thinking if you've got a property portfolio, or if you know anybody who's got a property portfolio, and how, in terms of how much you can save. But if you've got any questions, if you have any, if you'd like to discuss a particular situation or scenario, do get in contact with me. My telephone number is there, and I'd be more than happy to help. Thank you very much.